Well, ladies and gentlemen, welcome to the IISS. It seems a very appropriate time to be talking about the state of the world economy and financial markets. And today we're very pleased that David Hale is going to be speaking to us. He is the chairman of David Hale Global Economics. He's a well-known and influential economist. Writes in many prominent publications very frequently, and he'll be talking to us, taking us through a bit of the situation in the US and in Europe. And then my colleague Dana Allin, who's well known to you, he's the editor of Survival and also senior fellow for US foreign policy and transatlantic affairs. Dana will pick up on some of the sort of political aspects of what David's going to say. So. David will speak for about 20 minutes, and after Dana has then spoken, we'll have time for questions and answers and a discussion. So David, over to you.
Okay, thank you. It's a great pleasure to be here today to see old friends at the Institute and to catch up on what's happening in the United Kingdom. Let me just begin by saying that I do regard the current time as almost unprecedented in my career in terms of the magnitude of uncertainty we have to confront, because the uncertainties in the outlook center very much on political issues, not just the business cycle, monetary policy, the traditional factors that guide the US and European economies. We really do have right now, I think, a very, very high level of political risk in both the US and Europe, which will determine what happens in the business cycle globally in the next 12 or 18 months. Now, if we start out focusing on the US, we've had now for the last 2 years what I would call a very contradictory economic recovery. We've had a spectacular microeconomic recovery and a very lackluster macroeconomic recovery. We've had over the last 2.5 years the most dramatic gain in US corporate profits in the last 60 years. This profit boom was very much a byproduct of what happened during the recession in 2008 and 9. During that period, American firms engaged in unprecedented cost cutting. We lost over 8 million jobs. We had a GDP contraction just over 5%, and the private sector reduced employment by 7.5%. We've never had numbers like that ever before in modern American history. In the severe recessions of the 1970s and 80s, employment fell by 3 or 3.5%, nothing like what happened 2 and 3 years ago. So it was a very, very dramatic corporate adjustment which occurred and didn't occur anywhere else in the world. In the downturn, German GDP fell by 6 or 7%, employment fell by 2%. In Japan, output fell by over 9%, and employment fell by 2 or 3%. Why? Because corporate behavior in these other countries is very, very different. Many German companies are not listed on the stock exchange. There's a very large Mittelstand sector, which is family-owned, and therefore they're not sensitive to how profits perform quarter to quarter and year to year. They have a much longer term vision of their business. They're much more concerned about protecting human capital. The same broadly applies to Japan. But American business, because of the stock market, because of the fact that all corporate executives now have option programs, has an obsession with profits, not just year to year, but quarter to quarter. And that's what triggered 2 and 3 years ago this very ruthless cost cutting, these very dramatic employment losses. Now, the macroeconomic recovery, in contrast to the corporate one, has been very weak. Despite the fact we had a severe recession 2 and 3 years ago, the average growth rate of GDP over the last 2 years has been only 2.5%. After the previous severe recessions in the 70s and 80s, the average growth rate in the first 12 or 18 months of recovery was 6 or 7%. So this has been the weakest recovery in living memory. It has not been weak compared to what happened back in 2001 and 2, or 1991-92, which were very, very modest, very, very small recessions. But it does compare very unfavorably with the recoveries from previous recessions that were quite severe. And the constraints on the economy are rooted in the financial crisis we had a couple of years ago. We did have, going into the downturn 3 years ago, a lot of consumer debt. We had a housing boom. And what we've had since has been deleveraging. we've had a balance sheet recession as the household sector tries to reduce its debt and basically cope with the fact that on average over the last 3 years, US house prices have fallen by 30%. The American household sector has had a wealth loss of close to $7 trillion because of these house price declines. And this, of course, has been very much a constraint on consumer spending. So we do have legacy problems left over from the crisis constraining the economy today. Now, in January of this year, most American economists turned more optimistic because of policy events which happened in Washington late last year. The President and the Congress agreed last December on a $700 billion stimulus program. They agreed to maintain the Bush tax cuts for 2 more years, to make a cut in payroll taxes, to introduce 100% first-year depreciation allowances for companies, and to extend unemployment benefits for 1 more year. This was worth over $700 billion, so economists began to increase their growth forecast from 2% to 3 or 3.5%. We also had Ben Bernanke making a commitment to an easy monetary policy. He promised to buy in the first half of this year $600 billion of government securities to pump more liquidity into the financial markets. And while this did not directly affect the economy, it did have an impact on financial markets. It helped to trigger a 30% rally in US equity prices, helped to encourage more commodity speculation, and it led to a modest devaluation of the US dollar against a variety of other currencies. So we had both fiscal and monetary policy pointing in an expansionary direction. But instead of having a recovery in the economy to 3% growth, we had instead 3 major headwinds that constrained growth. First, the revolutions in North Africa. This led to a large rise in oil prices, 30 and 40%. And that very much squeezed consumer spending going into the spring. Secondly, the Japanese earthquake, which disrupted global automobile output, not just in Japan itself. In the United States, the Japanese car companies account for 30% of output. And during April, May, and June, they cut output by 70%. Then we also had some quite severe winter. Very, very bad winter storms in February, which hurt the economy. And then in April and May, a lot of cyclones in the south and west. So US growth in the first half of this year was only 0.7%, well below the forecast prevalent back in January. Now, by June, American economists were once again hopeful things would get better in the second half of this year because these headwinds were fading. The price of oil peaked in May and was declining. The Japanese earthquake problems were being corrected as the Japanese supply chains were restored, and weather wasn't an issue this summer. So by June, most American economists thought we'd simply have, instead of a strong first half, a good second half, again with the economy going back to a growth rate of 3 or 3.5%. But then in July and August, we had new shocks. We had the negotiations over the US debt ceiling, which had a very, very negative effect on business and household confidence. Then we had 6 or 8 weeks of quite extreme volatility in the stock market, with a 17% decline in share prices in late August compared to where they were in early May. And this very quickly turned into a global stock market decline. Germany fell by over 20%, Brazil fell 20%. We had corrections in many countries, both developed countries and emerging market countries. So in July and August, American economists again became apprehensive. They began to cut their forecasts from 3% down to only 1 or 1.5%. And some even began to warn there might be a new recession. Now, I think there are 5 arguments against the US having a recession at the current time. The first is the economy's cyclical sectors, housing, automobiles, investment, have not recovered from the downturn we had 2 and 3 years ago. They're still at quite depressed levels compared to where they were at the previous peak. Therefore, these sectors can't evolve very far. And because of the sectors that drive the business cycle, that, I think, lessens the risk of a new downturn. Secondly, monetary policy remains very, very accommodative. The average level of real interest rates on the eve of previous US recessions was 3.5%. Right now, real interest rates in the US are minus 2% because the Fed funds rate is close to 0, and inflation has in recent months been averaging around 3.5% in lag response to the oil price increases. In addition, the Federal Reserve promised a couple of weeks ago it will keep interest rates close to 0 for 2 more years. So monetary policy is very, very supportive. Thirdly, the corporate sector, for the reasons I mentioned a few minutes ago, is very healthy. Corporate profit margins are at record highs. Corporate balance sheets have $2 trillion of surplus cash. There's no pressure right now in the corporate sector to engage in the kind of cost cutting we saw 2 and 3 years ago. On the contrary, firms now have an incentive to take advantage of these depreciation allowances, 100% depreciation allowances in the final 4 months of the year. Fourthly, the household sector has been deleveraging. It's reduced its leverage by $1 trillion over the last 2 years. A lot of this is because of debt defaults, but some portion is also simply debt repayment. The household savings rate has also gone from 1% a few years ago to over 5%, and there has been, because of low interest rates, a big decline in household debt servicing costs. Over the last 2 years, they've fallen by $250 billion. So this gives consumers more potential spending power as they make smaller payments on their debt. Finally, the American banking system is much healthier than it was 2 and 3 years ago. In 2008 and 2009, it lost over $1 trillion on a lot of bad debt, a lot of bad securities. This year, it's earning an average return on assets just under 0.9%. There's been a big strengthening of its equity position. The equity asset ratio is now over 11% compared to 9.2% 2 years ago. So all these factors tell me we should not have a recession. But there are 2 risks. One is fiscal policy. Obama administration produced a budget back in February for the next couple of years, which shows there could be, in the year ahead, significant fiscal drag. First, the tax cuts enacted by Congress 9 months ago will expire in December. This could set the stage for tax increases in January over 2% of GDP. Secondly, the Obama spending programs announced 2.5 years ago are now unwinding. And one of the biggest hits in these spending programs is aid to state and local governments. They've been running very large fiscal deficits over the last 3 years, so Washington gave them $160 billion in aid to try and cope with these deficits. Despite this aid, they did shed, over the last 3 years, over 600,000 jobs. But if they hadn't had the federal aid, they might have lost 1 million jobs. But this aid is winding down very rapidly. In the new fiscal year, it'll only be $5 billion compared to $60 billion last year. So we could lose a couple 100,000 more jobs in the year ahead in state governments. Now, Obama recognizes fiscal policy is dangerous, and he announced a couple days ago in a speech before the Congress a plan to have in the year ahead $447 billion of new fiscal stimulus. He wants to maintain the household tax cuts or even increase them. He wants to give tax credits to small business for hiring new workers. He wants to give $35 billion of new aid to state governments. And he wants to have $100 billion of new infrastructure spending. All of this would be on the margin, I think, relatively stimulative. Could be worth 1.5% or even 2% of GDP. But it's not clear we can get it through Congress. The Republicans don't like the idea of more aid to state governments. They don't like the infrastructure program, but they might agree to maintaining the tax cuts. But there's no agreement how to pay for it. Obama has come out in the last day advocating higher taxes on the wealthy. But Republicans don't like to raise taxes on anybody, so we will probably have to have negotiations as part of this larger congressional process over deficit reduction to try and find some way to accommodate Obama's proposals. And we just don't know what's going to happen. We probably won't know until earlier mid-November, and this does loom as a major uncertainty for the U.S. economy in the year ahead. The second risk, of course, is loss of confidence. We had big declines in confidence surveys in July and August for both households and business. But there's no sign yet of this affecting the economy. We had good gains in retail spending in July. In August, retail sales were flat. But there was no decline despite the loss of confidence. We had respectable employment gains in June and July. In August, we had no employment gains. But part of that was because of strikes. If we hadn't had the strikes, we might have had job gains of 65,000 in the private sector. So we can't yet say that this confidence decline is crippling the economy. But there's no doubt it looms as a risk. It looms especially as a risk for the consumer spending by high-income people. What has led American retail sales in the last year is spending by the most affluent. They account for 20% of the population and over half of retail spending. And they have benefited from the very large rally we had in the stock market over the last 2 years. That gave them more confidence. But now that the stock market's down by 15 or 16%, they could now lose their confidence, become more cautious, pull in their spending. And if they do, that could give us in the final months of this year relatively weak consumer spending outcome. So the US economy right now is very vulnerable. Vulnerable on the fiscal policy front and very vulnerable on the whole issue of confidence. And we just don't know exactly how it will play out. I'm confident we can achieve a 2% growth rate here in the third quarter. 2% is certainly possible in the fourth quarter. But if we don't reverse the fiscal drag, the growth rate in the first quarter of next year could be 1% or even less. So we're looking at a US business cycle where we have, for the time being, a lot of vulnerability. If we turn to Europe, we've had really, going back over the last 2 years, two economies. A relatively buoyant north, led by Germany, Sweden, Austria, and Holland, and a very weak south, with very bad recessions in Portugal and Greece, and also Ireland, and just simply sluggish growth in Italy and Spain. What's happened in the last few months is there's now a broad-based slowdown all over Europe. The German boom is over, and German growth in the second half of this year may be only about 1% compared to 3.5% last year. Meanwhile, the recessions will continue in countries like Greece and Portugal. So we're looking at a general slowdown in Europe that could give us a growth rate in the new year of only 1 to 1.5%. Now, the bigger issues in Europe are very much political, and they center on this whole issue of what to do about Greece's debt and how to help countries like Greece avoid the risk of default. And this has been evolving now over the last 15 or 16 months on an incremental basis. The European countries agreed in May of last year to give Greece a $108.9 billion rescue program, €109 billion rescue program that would last for a couple of years. This allowed Greece to avoid default last year. They also agreed to create a new European financial stabilization facility to help other countries that got in trouble. In November of last year and April, May of this year, this rescue fund came to the aid of Ireland and Portugal. We had a further rescue program announced for Greece in late July. At the same time, the Eurozone countries agreed to give this financial stabilization fund more resources and new powers. The powers to intervene in European bond markets that get in trouble, and also to make loans to banks that suffer losses and need to recapitalize themselves. And right now, these new powers have to be approved by the 17 parliaments in the Eurozone. It's gone through the parliaments in France and Estonia and a few more countries, Hungary, but it still is to be voted on over the next several weeks in the other countries. And the big vote pending next week, of course, is Germany. The Bundestag has to approve this sometime towards the very end of September, and Angela Merkel, of course, is very much proposing this, even though she's had dissension in recent days from her coalition partner, the Free Democrats. Now, I think basically what we're looking at is a muddle-through scenario. There'll be enough aid given to Greece to avoid default, but Greece will still be suffering from a very, very severe recession. Unemployment in Greece by this time next year could be 20%. So this leaves us with really a lot of ongoing uncertainty. And the two uncertainties center first on German politics and secondly on Greece politics. How long can Merkel maintain a coalition in Germany to keep supporting these rescue programs? Right now, she has dissension in her own party, but so far she's been able to contain it. Ironically, the opposition party, the Socialists and the Greens, are advocating more policies to help Europe, not less. But she has dissension and she has disagreements in her own party. But so far, she's prevailing. And the reason is very simple. The German policy elites believe that monetary union has become essential to Germany's prosperity. German exports are half of GDP, one of the highest ratios in the world. And 60% of those exports go elsewhere in Europe. So exports to Europe are 30% of Germany's GDP. And if Germany did not have the monetary union, what you would have had over the last 2 or 3 years would have been massive devaluations by other European countries against the German Deutschmark. 50 or 60% in Greece and Portugal, 30 or 40% in Spain, who knows, maybe even 25% for the French franc and the Italian lira. But what you would have had is the German mark playing a role somewhat analogous to the Swiss franc here in the last few months. Upward pressure, raising danger for German industry and German business. So German policy elites are very committed to the monetary union, and this is still holding up even though we've had more dissension on these issues in recent weeks. The other issue, of course, is Greek politics. How long can Prime Minister Papandreou impose very, very severe fiscal austerity in a country suffering from a very severe recession? If you polled 100 economists, 95 would say Greece should default and give serious consideration to leaving the monetary union, bringing back the drachma, so it could have a massive devaluation to make the country more competitive. Indeed, my old friend Nouriel Roubini has an article in the Financial Times this morning advocating exactly that. But Papandreou knows if he defaults, he will, at a stroke, wipe out the Greek banking system, because Greek banks' holdings of Greek government debt exceed their equity capital. He knows if there's any speculation about bringing back the drachma, the Greek banks would lose practically all their deposits to capital flight. Over the last year, they've lost 20% of their deposits simply because of uncertainty. But if Greek people saw the drachma coming back, you'd have massive capital flight. So you could, in theory, default. You could, in theory, leave the euro. But getting there would be chaotic beyond belief. And Greece would probably have to negotiate some new aid package from the European Union to finance the transition. Because right now, Greece has a primary budget deficit, a deficit over and beyond the interest payments it makes on the debt, so the government would have no way to fund itself. The banks would all implode, and the government could not recapitalize them because the government has no resources. Greece would have to have more aid from Europe simply to finance itself through a default, not to mention withdrawal from the monetary union. All of these loom as very, very high risk, very, very dangerous choices, and therefore Papandreou simply doesn't want to do it. He wants to stay in the monetary union, get financial aid, and then just stick to these austerity policies, hoping, looking out 2 or 3 years, the Greek economy can finally have a recovery. So it's a very, very difficult environment. It's very dangerous. There have been tensions as well in the European Central Bank. Axel Weber resigned back in February because he was protesting the policies last year of having the European Central Bank buy Greek, Irish, and Portuguese debt. Last week, Jürgen Stark resigned from the Bundesbank board, protesting the fact they were now buying Italian and Spanish bonds. There are deep, deep divisions on this issue right in the European Central Bank itself. In 6 weeks, Jean-Claude Trichet will retire as the European Central Bank president. He'll be replaced by Mario Draghi, currently the head of the Italian Central Bank. The politics of this will be quite difficult because there's no way that Mario Draghi can in the new year buy lots of Italian government debt without very much jeopardizing the confidence of the German people in European Central Bank policies. That's why it's essential we have the Financial Stabilization Fund take over these responsibilities to lessen the politicization that's going on with the European Central Bank with their recent debt intervention policies. So this whole situation is very, very open-ended. The European currency has become a problem without a solution. There is no simple answer to these questions. There is no simple answer to these problems. They're going to be festering for a long time. But it appears at the current time that we will go for the muddle-through scenario. No major Greek default, financial aid from Europe and the IMF, the status quo will continue, and all we can do is stay tuned to see how the Greeks cope with their very severe recession and all this fiscal austerity. If we turn to the larger world, the news has been better. We had in the last year very high growth rates in the emerging market countries, over 10% in China, 8.5% in India, 7.5% in Brazil, 10% in Peru, and growth rates over 7% in 10 African countries. Ghana because of oil, Nigeria, Zambia because of big new mining developments, the DRC because of mining, things like that. This year, the big issue in the emerging market countries is inflation. The big rise in food prices last year, the increase in oil prices this year, has pushed inflation to relatively high levels. China's inflation rate last month was 6.5%. A year ago, it was less than 2%. Brazilian inflation rate in August was 7.2%. Indian inflation rate's over 9%. So we've had in the last several months monetary tightening all over the emerging market world. India's raised interest rates 12 times. Brazil's raised them 10 times. China's raised them 5 times. They've also increased bank reserve requirements 11 times. But now, because of all the uncertainty about the global economy, monetary policy in the developing countries is going on hold. There won't be any further monetary tightening. And last week, Brazil became the first emerging market country to have a surprise interest rate cut, 50 basis points, because of concern about the global slowdown. Because inflation in China, I think they won't cut interest rates for a long time. But they might, by the end of the year, be willing to cut bank reserve requirements a little bit after having big increases over the last 12 or 18 months. But China's leadership is very focused on the inflation issue. Therefore, they're not going to rush to stimulate. They're not going to give us what they gave us in 2008 and 9, a massive stimulus program to compensate for weakness in the global economy. But what we're looking at in all these countries is not recessions. We're simply looking at growth moderating. Chinese growth will go from over 10% to 9.5% this year, probably 8.5% next year. Indian growth will go from 8.5% down to 7.5% this year, probably the same next year. Brazilian growth is going down from 7.5 to 3.5, Peruvian growth from 10 to 6. These were all quite respectable numbers, but they're not quite as booming as what they were 9 and 12 months ago. So we will have a continuing pattern here in the next 12 or 18 months where emerging market countries are the growth leaders. That may be true not just for the next 2 or 3 years, it may be true for several years. But there's no doubt that developed countries will not have robust growth rates in the year ahead. They've got constraints on fiscal policy. Their monetary policy is already highly accommodative. There's not much more they can do to make it accommodative beyond where it is right now. We could get new quantitative easing by the Bank of England this autumn, as proposed by Adam Posen. If the American economy is truly weak this winter, we're not going to give us more quantitative easing in the United States. But these policies are very much marginal. They don't have a direct and immediate impact on the real economy itself. So we are going to have, I think, in the year ahead, a continuing story of relative weakness in the developed countries, but still steady, moderate growth in the so-called emerging market countries. Thank you very much.
Well, David, thank you very much. I think there was some good news in there. No recession in the US, Europe to muddle through, but obviously, as you said, all very much clouded in uncertainties and vulnerabilities. Now over to Dana.
Thanks, Alex. I'm going to try to make this, and we'll make this very brief because I know you want to get to Q&A mainly to David Hale. But I've been asked to reflect on the political and strategic implications of the continuing crisis, and I thought I'd try to do so very quickly on 3 levels. I mean, first, if you'll forgive me, I just want to say something and hopefully provoke some discussion, something about the strategic implications of bad ideas. I'm not an economist, but I do think the burden of evidence has to fall on those who, in the face of the recurrence of the crisis, of the fundamental shape of a crisis that led to the Great Depression, are supporting austerity policies in the US, UK, and continental Europe that are broadly similar to those pursued by the US, UK, and Germany in the early 1930s. Now, if this you may contest that it's similar, in which case I'd like to hear that case, but if this broad similarity is not contested, then it seems to me that a supporter of simultaneous pro-cyclical austerity needs to explain why it was a mistake then, but not a mistake now. Now, by the way, I'm not saying that every implementer of austerity has any real choice in the matter. I mean, David Hale just described in poignant and excruciating detail the dilemma that the Greek government faces. But I'm just arguing that this is a very scary repeat of some bad ideas. Now, are the strategic implications of repeating the mistakes of the 1930s likely to be as dire a second time around? Probably not. I mean, the crisis today is very bad, but it's obviously not as bad. And anyway, our societies are a lot richer today. But that said, the implications for world order, which was the grand theme I was asked to reflect on, are just obviously very hard to calculate. In Europe, a possible breakup of the euro, I realize that the previous speaker said he didn't, I think he was saying he didn't see that as very likely, but it's certainly possible. Among its dangerous economic consequences, it would be a huge ideological blow to people like me who have applauded the European project and also supported the original idea of the euro, which we may have to admit was a mistake, although it does seem to me that the crisis of the euro is in a certain way a crisis of European enlargement, but that means enlargement, including countries like Italy, which were obviously founding members, so that's a complicated argument to make. The second level that I wanted to touch briefly concerns sort of the politics of austerity in the United States. Now, a few of you heard me on this subject at the GSR, at our Global Strategic Review last week in Geneva. So I apologize for basically briefly repeating my main points. But, just to say along with what I think our main speaker just said, we are trying to get out of a balance sheet recession, the worst since World War II. Essentially individuals have too much debt and are trying properly to save rather than spend, so the government needs to step in and fill the hole. There have been various steps to try to do that. The stimulus so far has averted a much greater depression, but it wasn't enough, and I think David has discussed some of the reasons, some of the headwinds that we're facing. The second aspect of the political debate in the United States, which has until President Obama gave his two most recent speeches, sort of overshadowed the real employment emergency, has been the question of the federal debt, which is a long-term problem. The United States is not bankrupt in any common sense meaning of the term. It can borrow money at very low rates of interest, but it does face a very serious long-term problem. The solution to which, and this gets, I think, to the strategic question I was asked to address, the solution to which is going to have to involve a combination of defense cuts, or at least restraint in defense spending, restraint in the growth of healthcare costs, and tax increases. Now, it's clearly the case when we're talking about defense cuts that what's needed is overshadowed by the issue of healthcare spending, because growth in healthcare spending is the main driver of the long-term deficit. But as a few of you heard me say a couple weeks ago, defense is the biggest item of discretionary spending, and I just think it's not politically realistic to imagine that you're going to cut spending on Medicare without touching defense. But in political terms, in terms of the American political crisis, which I think is a real crisis, the biggest problem is taxes. And this crisis was played out in this summer's debt ceiling negotiations, which one could also characterize as hostage negotiations, which led to an obvious degradation of confidence in the American political system. And the root of that political crisis is exemplified by the fact that almost every Republican member of the U.S. Congress has signed a pledge that he or she will never, under any circumstances, vote for a bill that increases net revenues to the United States government. It's not just that they've signed the pledge, which I guess they could break, but this pledge reflects an ideological certainty and polarization in American politics about the size and the role of government that I think is probably sharper and more bitter than any time in living memory. And I think in historical terms, one would really have to go back to the Franklin Roosevelt administration to have a comparable debate about what the government is and what it should do. In any event, I would just observe that the pledge not to ever raise taxes does not seem to me consistent with, maybe it's compatible with, but it doesn't seem intellectually consistent with the idea of the United States as a superpower. Finally, on the third level of what I wanted to reflect on, is to move beyond the partisan political question or the political crisis, and just imagine that this particularly acute political dysfunction did not exist. I emphasize it because for me it is the overriding strategic factor right now and for the foreseeable future. But let's assume that it's cured. It could be cured, for example, by the election of a President Romney who, upon election, reverts to the sort of obviously sane and sensible and decent man that he is. But the question is there a bipartisan problem about the way that both parties conceive of America's world role that's not really compatible with long-term economic realities. This is the subject, this is the penultimate chapter of a book that on a Delphi book I'm co-authoring. And we haven't written that chapter yet, so I don't really know the answer. But I'm an old student of Professor David Hale, who is a close and longtime friend of Robert Skidelsky. And I've seen them disagree about a lot, but I was struck when Skidelsky addressed our Global Strategic Review a couple years ago. He strongly endorsed a basic theme of Hale's, which he attributed to David Hale, which concerns what Charles de Gaulle called the exorbitant privilege of the U.S. that the U.S. derived in large measure from the role of the U.S. dollar, which was related to the extraordinary burden that the United States assumed after 1945 in financing the world's and especially Europe's post-war economic recovery and in extending its military protection against Soviet threats. But there were certain problems with the financial underpinnings of this project, which carried significant long-term problems for the international system. And what Skidelsky referred to was the seigniorage that was accorded to the United States through the dollar's reserve currency role, allowing Washington, one thing that allowed Washington, in effect, to ignore fundamental strategic choices and limits. In other words, the power to print the world's currency conveyed the ability to finance a global strategic role without commensurately taxing American citizens. Arguably, the ongoing crisis stems at least in part from this American habit of ignoring limits, and its latest manifestation would have been in the Sino-American financial and trading relationship, which created a large share of the imbalances that helped cause the financial meltdown. Now, the killing of, and here I'm going to conclude, the killing of Osama bin Laden inspired some interesting reflections on whether bin Laden at least partly succeeded by pursuing a strategy against America that he had learned in the demise of the Soviet Union. And some of you will have seen him quoted as saying, along with the Mujahideen, we bled Russia for 10 years until it went bankrupt. And then he asserted that he would repeat this success by bleeding America to the point of bankruptcy. Now, bin Laden is dead, while America remains in many respects very, very strong. But one has to concede that he was shrewd about the kind of American national psychology that would compel the United States to expend a lot of treasure and a lot of blood in relation to 11 September. And there were also arguably huge indirect costs stemming, as commentators like Ezra Klein have written, from the Federal Reserve's decision to cut interest rates to counter both a fear-induced recession as well as high oil prices after the Iraq invasion. Bill Emmett had a piece in the Times a few weeks ago where he went actually further. And he observed, and it was a kind of counterfactual piece, but he observed that the property bubble of the early 2000s was handled in policy terms very differently from the dot-com bubble of the 1990s. And he asked why. And his argument his answer went to the realm of governing psychology. He referred particularly to Alan Greenspan's management of the Fed at that time. And he asked if Mr. Greenspan, and I'm quoting him here, if Mr. Greenspan was so ideologically determined to keep his hands off the markets, why did he raise rates 6 times to burst the dot-com bubble in 1999? Why, after 2001, by contrast, did he keep pumping in credit to housing and banks, even as another bubble formed? Why did fiscal policy, and then he talks about fiscal policy under President Bush and goes to Europe as well. Emmett's answer, the answer is simple. There was a war on, or rather 2 wars, not even counting the vague one on terror. At such times, the inclination to risk an economic slowdown or new recession diminishes. After 9/11, President Bush said that Americans should do the patriotic thing and go out and spend again. This is obviously all counterfactual speculation, but it seems to me that Emmett is onto an important insight about the psychology of the American political class in relation to America's world role. That class is not going to concede that the role of world policemen requires an explicit trade-off against Americans' living standards. The Johnson administration wasn't willing to do so regarding the Vietnam War, and the George W. Bush administration wasn't willing to do so regarding Iraq. And just to insist that I'm not taking cheap shots here, even though, in my view, Vietnam and Iraq were mistakes and unnecessary wars, there could be a necessary war arising from America's global security role. Let's say a war on the Korean Peninsula caused by the belligerent craziness of one side. But just because it was necessary doesn't mean that any administration, Democrat or Republican, is likely to explicitly ask Americans to accept lower living standards to pay for it. And I think the interesting exam question is whether this hypothetical future administration should so ask.
Dana, thanks very much indeed. In a minute, I will invite David to just pick up on Dana's comments about the parallels with the 1930s, if you would. But let's open it up to questions. Who would like to start?
Hi, Fabio. Good to see you again.
Well, first of all,
Sorry, could you use the microphone, please?
thank you for you being so merciful not to mention too much my country, Italy. But my first question is this. As you probably know, last night, Standard & Poor's downgraded Italy. And we have a very, very complex situation with the trials of Mr. Berlusconi. To what extent do you think, if there is no change in government in the next few weeks, like there might be, but if we go to elections next spring, which is probably the most likely scenario, to what extent can German politics and the euro survive this scenario, which is really protracting the agony of the Italian government, so also of the Italian government debt situation, with the spread this morning went over 400 basis points. Yeah. The first question. The second question is about China. To what extent such a rigid economy based on the investment account can simply decelerate from 8 to 6%, from 10 to 8%, as you said, or rather just collapsing because the whole sort of architecture of its growth may be just too rigid to simply adjust? Thanks.
Those are both very good questions. Let me take the Chinese question first, because I think it's straightforward. China has had very dramatic gains in capital spending over the last 10 years. But China's ratio of capital stock per capita is where Japan was in 1970. It's not high in absolute terms. It's only high compared to where it was 10 or 15 years ago. So there's still room in China for a lot more capital spending. Plus, they have an urbanization process going on with 10 million people every year leaving the countryside going to the cities. That means they have to build New York City every 12 months. That also guarantees a lot of capital spending. There have been elements of a property bubble in the last 2 years, which the government has tried to fight by changing lending terms, making it hard to get second and third mortgages, having penalty interest rates, things like that. But in this real estate bubble, there hasn't been a lot of leverage. Half the homes sold in Shanghai last year were sold for cash. So you don't have an Anglo-Saxon type phenomena of financial speculation. What you've got is just straight investments by people's cash to buy property. So you don't have the same financial risks you'd have in America or Britain. So I think China can gradually unwind. And over 10 years, I do think the consumption share of GDP will increase from 35% to something more like 45%. And the investment share will decline as the consumption share goes up. But it will be an incremental, gradual transition. It won't be dramatic and all just done over 2 or 3 years. On the Italian question, the situation with Italy is it has the largest public debt in Europe, the third largest public debt in the world, 1.9 trillion euros. And Italy is simply too big to rescue. There is no easy solution. The European Financial Stabilization Facility will have 440 billion euros of funds available if they don't leverage it. They've already tied up about 200 billion euros with Portugal, Ireland, and Greece. Leaves 240 billion to go. How much would it take to rescue Italy? We just don't know. The European Central Bank in August probably bought about 40 billion euros of debt, and interest rates fell quite sharply in the first few weeks. They came down 100 basis points. With the S&P action overnight, it's unclear how much buying we would have to have. And as I mentioned, I think it would be difficult for Mario Draghi as the new ECB president in 6 weeks to engage in big intervention because it'll, rile German public opinion. Hopefully, the Financial Stabilization Fund will be empowered by them to do it, and they may intervene to try and help out. But, if the problem centers on Italian politics, then to get confidence back, you will have to have political changes in Italy. Now, Berlusconi has been a controversial man for some time, not just because of his policies, but because of his personal lifestyle. And what's amazing is you've got court actions over that and things like that. In most other countries, he would have resigned by now, but he holds on. And I just don't know how long he can hold on. The fact he's been so resilient tells you he obviously has tremendous power in his own party and his coalition. But, the Italian situation may have to be resolved, as you suggest, by a change in government. There was a lot of speculation 6 months ago there might be a technocratic government led by Mario Draghi, for example. But now he's going to Frankfurt. But there should be somebody else who could play that role if necessary. And if that were to happen, that would probably lower Italian bond yields 50 or 75 basis points. So it's very much a political question, and there's no simple, easy answer. Italy is solvent. Italy right now is running a primary budget surplus, 0.2% of GDP. Italy has had many times in the last 20 years big fiscal reform programs, bringing the debt ratios down a little bit. Italy's budget, enacted in the last week by the Italian Parliament, has the potential to balance the budget by 2013 and to reduce the public debt over 4 or 5 years by 10% of GDP. Italy has laid the groundwork for fiscal progress. But obviously the economy is still very subdued, and if we don't get higher growth, that will jeopardize tax receipts and things like that. So Italy will need some better leadership to create confidence to get a better economy. And I hope it can happen quickly over the next several weeks, as you suggest.
Thanks. Yeah, in the back row there.
My name is Christopher Jackson. I'm a student at the University of York and one of the members of the IISS. I want to ask a question about credit rating agencies. I think maybe it's a slight aside to this issue, but I hope it's still relevant. I wanted to ask if you think a lot of people have criticised the roles of agencies like Standard & Poor's for their downgrading of the United States. And I wanted to ask if you think that that's had an effect on the credibility of a lot of these credit rating agencies, and if it has had an effect, it's made them less credible, as it were, for those actions. If that then means that the credit ratings within themselves will become less useful and of less value going forward. So that's my question.
Well, the big loss of credibility among the rating agencies occurred 2 and 3 years ago. Going into the big financial boom we had 5 and 6 years ago, they gave very high ratings to a lot of high-risk securities, many of which then defaulted. So the rating agencies suffered profound embarrassment. There were congressional hearings. They were very severely criticized. The official reports on the crisis basically blamed them for part of what happened because they earned very large fees, giving these securities, high ratings. So their credibility is already greatly damaged. Now, the downgrades we've seen this year in various European and U.S. government securities have generated protests. When they downgraded the U.S., Tim Geithner condemned them, of course, as did the administration. When Portugal got downgraded back in February, several European officials said the same thing. They felt it was unjustified, that Portugal was making serious steps to try and address its fiscal problems. What they did was unfair. So there'll be continuing controversy. Now, in the case of the U.S., only one agency is downgraded. The other 2 big agencies, Moody's and Fitch, have not done that yet. If we don't have serious fiscal reform after our presidential election, they could do that in 2013, but they haven't done it yet. So we don't have what I'd call a consensus. But S&P did not like what happened in Washington this summer, the negotiations over the debt ceiling. It felt the whole thing was, very badly conducted. They felt the package we got, $1.2 trillion guaranteed, was inadequate. They wanted $4 trillion of deficit reduction. So because the political system could not deliver it, they took this action. But the other agencies said, we'll give the U.S. more time. If Britain had not had, going back a year ago after the election here, a tough fiscal austerity program, Britain would have been a prime candidate to lose its AAA rating this year. Would have been very, very vulnerable. But the government's actions did persuade the agencies that the UK would have effective action over the next 4 years to cut the deficit. But the UK was a prime candidate this time last year for a lower credit rating.
Thanks. Yeah.
Sorry, Matthew Hunt, political risk consultant and member of the Institute. I think you mentioned the cuts in growth forecasts for some emerging market economies, but also the projected sluggishness at best of growth in Europe. Given that some emerging markets have sort of started trading with each other, I'm thinking of two-way process is strong between Brazil and China, and India and China, Brazil and India. To what extent are some of these, I guess, emerging economies, we still call them, but probably emergent by now, insulated from the slowdowns in the West, Western Europe, and North America?
Well, as we saw in 2008 and 9, when there's a major downturn in the old industrial countries, it has a very dramatic effect on these countries through trade. Because most of the developing countries have very high ratios of trade to GDP. For Singapore, it's 200%. For Malaysia, it's 100%. For Korea, it's 80 or 90%. So if we have a major trade downturn, they'll be very adversely affected. Other countries don't have large exports of manufactured goods, but they rely very heavily on commodities. Brazil's big exports now because of China or iron ore and soybeans and things like that. Argentina and soybeans. Peru and Chile, it's copper, gold, other base metals. So what you would have probably in a major downturn would be falling prices. And that would then hurt their export income and so on. Australia is in the same category. Australia now sends 25% of its exports to China, led by iron ore and coal. So I think, there's no clear escape. But the advantage that developing countries have in general is their public debt ratios are well below Europe and North America. Their public debt ratios aren't 80 or 90%, they're more like 20 or 30%. So they do have some room for fiscal stimulus. Many have in the last year, for reasons I mentioned in my talk, raised interest rates, in some cases by quite a lot. So a way they could stimulate their economy next year would be to cut interest rates. Could cut by a lot in Brazil and India because they've raised interest rates so far. China could cut moderately. So I do think developing countries will have tools to fight a global recession if it comes to that. But they will not be able to avoid the impact of trade because they do rely very heavily on exports as a share of GDP.
In the back row there.
Naomi Jeffries from the Commonwealth Office. We've heard very rightly a lot about the global order and sort of the impact on major developed and emerging markets. Absolutely correct. Just be interesting to know if you have anything to say about the smaller markets. I'm thinking particularly of things like the Caribbean. Partly prompted by your answer there. I mean, somewhere like St. Kitts has over 200% debt to GDP ratio.
Right, yeah.
So they're quite dependent on things like the American market, what's happening, household confidence if they decide to go on a Caribbean holiday this year. And what do you think the future is for those sort of much smaller economies and markets?
Well, they rely very heavily on tourism, and tourism is discretionary spending. Now, the good news in the last year is we did have American consumers who were affluent increase spending quite a lot, and that was good for the Caribbean islands. If now, because of a falling stock market, the high-income consumers spend less, that'll have an adverse effect on the Caribbean countries. So they're very, very vulnerable. They have other games they can play too. Most of these countries still recognize Taiwan. They could turn to the PRC and get $1 billion of foreign aid if the PRC still wants to play that game. Now, because the Taiwan relationship with China is better, they're not doing as much to take away Taiwan's diplomatic representation. But to the extent there are 24 countries that still recognize Taiwan, many are right there in that region. And they include all of Central America except for Costa Rica. So I think there are various things they can do, but obviously, it's very difficult. These are very, very small countries. Their populations aren't very large. And, they might have some luck attracting some high-tech company which has something really innovative that might be able to employ a few people. Costa Rica now has a very big high-technology industry because of an Intel plant that went there a few years ago. But, Costa Rica is a few million people. An island of 100,000 people just won't have the same potential to attract any industry. So they're very, very constrained. But I do think if we don't have the American high-income consumers pulling their horns too much, they should be okay.
Thanks. In the second row.
Hello, Gary Rajendran, analyst here at the Institute. I had a question on quantitative easing. And I
which country?
On quantitative easing.
Quantitative easing.
QE2 in particular. And I wanted to draw your views on what you think the effect of QE2 has been, in particular on emerging market economies, asset price rises and inflation. Do you think that's much of a domestic story, or do you think, is there a link, a causal link between US monetary policy and QE2 in particular and inflation in those regions?
Well, the Federal Reserve announced this policy about a year ago at this time with the Jackson Hole speech by Ben Bernanke. He was promptly criticized by the Asian central banks, in particular China, but also Brazil. on the grounds this was a policy to devalue the US dollar. They also feared it might generate capital flows to emerging markets, encouraging property bubbles, asset inflation, things like that. So in general, emerging market central bankers were critical. And one factor constraining Bernanke from doing this again at the current time is concern about this criticism. When I saw Bernanke for a private meeting right after he went to the new policy last November, and he told me that generally he had support from the G7 countries, the Bank of England, the Bank of Canada, but he did take a lot of criticism at the G20 meeting from the emerging market countries. So, did he devalue the dollar? Yeah, on the margin he did. Did he encourage higher commodity prices? Yes, on the margin he did, which was positive for some developing countries because they export commodities. Did it encourage asset inflation? Probably on the margin it did because there were pretty buoyant stock markets in most of these countries 9 and 12 months ago. But I don't think it was, how would I put it? I don't believe the effect was dramatic. I would say, again, it's on the margin. The Bank of England came out with a report yesterday on how QE affected the economy here. They felt the effect was to bolster growth modestly. They felt the whole thing was benign. But again, very modest benign, not significantly benign.
Thanks. Front row here.
I'm Chair, Asian Pacific Affairs. I have a very general question for Dana. U.S. present economic problems. U.S. economic problems.
Yes.
How is this likely to translate U.S. willingness to be involved in security issues, at least in midterm frame, globally in general and Asia in particular?
I think that I'll answer the first question last. The current American role in the Asia Pacific is not debated in the United States, and it's not debated among strategic elites. There's a lot of questions about what we should do in Afghanistan, and much of that debate is driven precisely by questions about budget deficits and long-term affordability. That does not apply to the Asia Pacific. That's specifically why I cited the idea of Korea. I think over the long term, there's a question about sustainability everywhere, unless certain imbalances are rebalanced. But I certainly do not see in this presidential election cycle, or regardless of who wins the next presidency, or regardless of what happens in Congress, a kind of real drive for isolationism, such as would be constituted by a withdrawal from the Asia Pacific.
Thanks. We'll come finally to Ben Barry over here. But when you answer, and this gentleman here also, when you answer them, perhaps you could also go back to the 1930s and look at what was being done right and wrong by comparison. Ben.
Do you think there's a risk of these trends you've both identified giving rise to increased protectionism, which could actually therefore derail globalization and make things worse?
Thanks. Just go to the
Yes, Gabriel Owen, member of the IISS. My question relates to the euro-dollar exchange rate. This appears it may be turning. We've seen a 10% decline recently. Do you think there's an element of a solution in this? And do you think there's an element of a solution in this to the eurozone problem?
There's no doubt if Europe had a big currency devaluation, not 5 or 10%, but 20 or 30%, that would help some of the troubled countries. Italy would be more competitive, so would Greece, so would Portugal. So I would say a large devaluation makes sense. And in this book, What's Next, which we just had published a few months ago, Anatol Koletsky has a chapter about Europe saying that's part of the solution, a big European devaluation. He's a columnist for the Times. On your question, I think we've been pretty lucky so far, despite the severity of the recession we had 2 and 3 years ago, there wasn't more protectionism. Now, the G20 countries and all their communiques said we shouldn't have any protectionism. Some countries, though, did. Argentina had more tariffs on imports. Russia had tariffs on auto imports. Indonesia had a few gestures in that direction, but nothing very dramatic. The danger now, of course, is if we do go back into a second recession, when unemployment's already high, that will magnify these protectionist pressures. Now, in the U.S., the Democratic Party has been protectionist for almost 20 years, since the end of the Cold War. And they have fought the recent attempts by Obama to get through these free trade agreements that Bush negotiated 3 years ago with Korea, Taiwan, and Panama. I think they'll finally get enacted this autumn, but it's been delayed for 3 years because Democrats are responding to trade unions who are very concerned about free trade agreements. Now, Romney, in his recent campaign speeches, has been attacking China for having undervalued currency, threatening to impose sanctions on China. This is the first time a prominent Republican has talked about protectionist trade policy. And I'm concerned, because if Republicans now move in the direction of the Democrats, that will greatly increase the danger of U.S. protectionism. It would also make it even more difficult to finish the Doha trade round, which has been stalled now for several years. So I think protectionism is certainly a risk, but not yet out of control. But it's a danger that will increase next year if we do have a new recession and unemployment goes to 11%. Yeah, there's a big difference between the 1930s and the current period. That is, in the 1930s, almost all countries were on the gold standard, which very much constrained their monetary policy. Today we have a new gold standard. It's called the European Monetary Union. So Greece and Portugal are now effectively on the gold standard, and they've lost control of their monetary policy, and this is giving them very, very severe recessions. But the United States, Britain, Canada, Japan have no such constraints. And therefore, we've had, in the last couple of years, highly accommodative monetary policy. Now, we had the danger in the United States 3 years ago of massive bank insolvencies, like we had in the early 1930s. But Hank Paulson saw that danger and got the Congress to approve a $700 billion bank rescue package. It was called TARP. And that money was used to guarantee that no major banks failed. We've had about 300 banks fail in the last 2 years, but they're all very small. 100 million in assets, 500 million in assets. No major bank has failed. But you could have had 3 years ago a failure by Citibank. You could have had some very major institutions collapse because they had so much bad debt and problems like that. So we prevented a repeat of what happened in the early 1930s when the U.S. lost over 3 years 1/3 of its banking system. But we do have in Europe a recreation of the conditions we had under the gold standard. And that is, for the countries that are in trouble, very, very restrictive. You do have now, I would say, very, very deflationary policies in Southern Europe, and they will be here for quite some time.
Great. Well, we've covered a great deal of ground in a short time. It's been absolutely fascinating. We have here a few copies of David's most recent commentary, which I guess the highlights of which, some of which we've just heard, and also some material on his book here, if anybody is interested. So please do help yourselves if you would like. But, yeah. Okay, and Sandy has some more if there's not enough. But I would like us all to thank very much both David and Dana for a really fascinating discussion. Thanks very much.